This is Retirement Keys with Anthony Kangemi from Crescent City Retirement Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Anthony provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is Retirement Keys with your host, Anthony Kangemi.
Welcome to Retirement Keys. I'm your host, Michael Fite with Crescent City Retirement Group. Today, I will be filling in for Anthony Kangemi. I would like to introduce my co-host, Tony Shore.
All right. Well, thank you so much, Michael. Great to be here with you today. And it's a big surprise for our listeners. Anthony is so busy right now. This is the busy season there. And I know he recruited you to host the show today for Crescent City Retirement. And I'm excited. This is the first time you and I have done the show together, isn't it?
It is. Yes, it is.
Yeah. Well, why don't you, before we get started, Michael, and before we talk about our topic, we're going to be talking a lot about planning ahead for taxes instead of looking back, planning for taxes in retirement. I know you have a lot prepared for us today, but first tell our listeners out there a little bit about yourself. How long have you been working with Anthony in Crescent City, and a little bit about your background?
Sure. Thank you, Tony. So a little bit about me. I am an investment advisor representative with Anthony. So he and I have the exact same credentials. Now, Anthony likes to tell everyone in our meetings, Michael is the numbers guy. He's the tax guy. He has a lot of different titles for me. But here's what I actually do. So I'm an investment advisor representative, the same as Anthony, and I have 10 years of accounting and tax experience. I got my bachelor's of accounting from the University of Southern Mississippi in Hattiesburg. And I have recently finished my MBA in finance through Louisiana State University on their online school. And so I've been with Anthony since October of 2022. It feels like it's been a lot longer than 1 year, but I've only been with him for just a year.
Oh, wow. But wow, your background and your education, that's really impressive. No wonder Anthony refers to you as the numbers guy with all that accounting and tax expertise. You're bringing a lot to the table there. And how's the past year been? Is Anthony pretty hard on you? Pretty tough boss?
Anthony is a wonderful boss. He's a
what
very
else would you say on the radio, right?
Well, of course.
But he
is
a great guy.
Anthony is one of those type people where he can see, he's a visionary. He sees someone, he sees the potential, and he sees what they can be, even if it's unbeknownst to them. Like, I never would have thought I would go into financial advising. My wife saw it, and Anthony saw it. And another one of our employees who connected me with Anthony saw it. But I always was like, oh, no, I'm going to be like a CPA. I'm going to be some kind of accounting or even a CEO somewhere because I have great management skills and I'm great with numbers. I never thought I would be meeting with clients about their financial planning and advising.
Well, I think it's a good stepping stone to moving on up, and I think it's a great way to round out your experience and what you can offer to people. I mean, you have the accounting background, and that you bring to the table, but also financial planning overall, and that's how you're able to help people, is to have that big picture approach and all that knowledge. I think more people who call themselves financial planners and financial advisors could really benefit from the kind of background and education you've had.
Absolutely. I agree. And the more I have done this with the work I've been doing with Anthony, the more I realize exactly what he initially saw in me when we first met, that yes, I am fit for this role and I will make a great advisor.
Well, we're going to tie in some of that experience that you've had and the education today, because you told me you want to talk about taxes, and in particular, taxes in retirement. How do you plan for taxes in retirement before you retire? That's the key there. And some of these are questions from Anthony's list that he and I have been going through the last several weeks. For the last few months, we've been tackling the document that you hand out to folks you meet with there at Crescent City, and that is questions to ask before you retire. Now, I think overall, we need to look at how people can have an efficient strategy for taxes in retirement, dealing with their distributions. In other words, what are they using for retirement income and how's that taxed? And just having an overall strategy, right?
Absolutely.
So, what about that? I mean, how can people build a tax efficient distribution strategy in retirement?
Sure. So that's a great question. And the first thing to realize is there are more than one types of investment accounts. This is something that I talk about a lot with clients, and some people don't understand this, and some people do understand it. It just depends on how familiar they are with it. So your more common one is going to be the qualified or traditional IRA. So IRA is just an individual retirement account. It's nothing fancy. All it is a souped up way of saying tax bank account. That's what it is. So the first type is a qualified IRA. Now, you might be asking, well, what is a qualified IRA? An example of that would be like a 401k at your job, or if you work for government, it would be a 403b or some other type of employer sponsored plan. Now, the reason why I start with this one is because this is what we see the most of. People come in with a large 401k balance ready to retire. One thing they may not realize, though, is every dollar that is they've contributed that has been put into their 401k and every dollar that has been earned is all taxable. It's all tax money. So that's the biggest one that we deal with. The second one is called the non-taxable account or a brokerage account. This is where you invest money outside of your employer to an investment agency. So let's say you have $10,000 and you're like, hey, I want to invest this in something. That initial $10,000 contribution is tax-free because you've already paid taxes on it. However, there is earnings that you get from dividends and interest that will be taxable. And then the third type of IRA is the Roth IRA. Now, the Roth has certain limitations on it. You can only contribute so much a year while you're working, and that contribution is a certain dollar amount every year until you reach age 50, and then you're able to do what's called a $1,000 catch-up provision, and it can be done for you and your spouse. But this money grows tax-free. Now, there's a way you can do it after you're retired to contribute to the Roth, and we might talk about that here in a little bit. So the way to be tax efficient with everything is to really leverage all types of these investment advisory, the IRAs that you have, and what is the best order, because the non-taxable or the brokerage account is going to have less tax implications than the qualified money. So what we do here is we take all the accounts that you have and we figure out what is the best strategy. If all of your money is qualified, there might not be a lot that we can do there, but what we can do is target what tax bracket you're going to fall into. If you have a good mixture of these, we can leverage some of the non-qualified with some of the qualified money to ease up on the tax distribution.
Okay. So what about RMDs, required minimum distributions then? How do they affect this tax strategy?
So RMDs, as Tony said, required minimum distributions, affects the tax strategy when people start taking out so current tax rule is at age 73. This changed at December of 2022 in the Secure Act. So it's now 73 years old. So at 73, you have to take out your required minimum distribution for your qualified accounts, or again, your 401k or 403b or whatever type of employer-sponsored plan. Now, most people are done working by the time they reach this age. If you're not, that's a different story. We can talk about that. You can get a little provision on that. But most people are done working, so they have to take out what the IRS requires to be the minimum. The issue that people run into is if they have not started any distributions ahead of this date, that number might be higher. So let's say an average client comes in and they have anywhere from 500,000 to $1 million in their 401k. Now, just want to preface this. If you're under that number, don't feel bad. We can definitely work with you. If you're over that number, hey, that's great. And that's amazing. And we can still help you as well. But for this example, let's say someone comes in with $500,000 of their 401k qualified IRA. In that 500,000, it has grown up to a point. So they're like, hey, I have enough cash in the bank. I don't want to use any of my investment money until I have to. Well, by just delaying more, you're allowing that amount of money to keep growing, and to keep growing, which means you're going to have to pay more taxes on this. I heard one advisor say, do you want to pay tax on the seed or do you want to pay tax on the harvest? So what we do is instead of waiting until our required minimum distributions, we develop a plan where we start utilizing some of this qualified money and start taking out a certain amount each year, regardless of whether they need the money or not, build it into their plans so that it's an easy transition when they hit that required minimum distribution age. So it won't spike your income or spike your taxes. It will be a nice little transition, still giving you a little bit of a raise every year to keep up with inflation, but it'll be a nice, smooth transition.
Well, I have a question about all this, about everything you've been talking about so far, and that is just in general, I think, at least my wife and I used to feel this way. Oh, we're not going to have to worry about taxes in retirement because we will no longer be working. And a lot of people, I think, have that attitude, but that's just not true, is it?
That's correct. So what a lot of people don't realize, now, keep in mind, this is something that it can be an annoyance, but at the same time, it's because of what you've done. So when your retirement income, which is passive income, is a certain point, your Social Security will be added to taxes. Now, I know Anthony has talked on Social Security taxation before, so if we do need a follow-up, we can. But up to 85% of your Social Security income could be added to your taxable income, depending on how much qualified money you're pulling out for your retirement. So to answer your question, Tony, on, well, I'm retired now, I shouldn't have to pay as much money in taxes. That's true. Majority of people, when they're working, have been paying between the 22 and 24% tax bracket. When you retire, because of the sources of income that you're pulling out of, and honestly, also, your expenses aren't as high. Your kids have grown up. If you had kids, hopefully your house is paid off, your debts are paid off. There's a lot of things that shouldn't be there expense-wise when you retire as they were when you were still working. So theoretically, you could live on less money. So depending on how much money you're pulling out of your investment portfolio will depend on how much your Social Security is taxed, but there will still be some taxable money because this 401k was tax deferred. So every year that you contributed to it, you got a tax break on your W-2. Your box 1 was a different number than box 3 and box 5. For those who don't know what I'm talking about, it's okay. Just look at your W-2. The next time you do the taxes, you'll see this difference. But you were getting a tax break all of those years. And the idea behind it was you were deferring your taxes from paying it in a high tax bracket to now you're retired paying it in a lower tax bracket. But
that's the idea anyway.
Exactly.
But that doesn't always work that way, does it?
It doesn't, because there's a few things that you can't help. One, you can't help what the IRS does. They change the tax laws. Right now, we know what the tax laws are for the next couple years, but we don't know what they are in the future. So that's one thing you can't help. The second thing that you can't help is you can't help the market fluctuations. We all want a positive market, which is a great thing. But the more money you earn in that qualified account, that means that's more taxes you're going to have to pay over your lifetime.
Yeah, and most retirement accounts that the majority of people I know anyway, and I think the majority of Americans are tax deferred, like 401ks, 403bs, traditional IRAs. Those are all tax deferred. So, hey, that's great for this year, right? We're not paying taxes on that money right now, but that might not be the best situation because aren't we in one of the historically lowest tax points right now? I mean, federal income tax is at historic lows right now, isn't it?
Absolutely. The jargon in the industry is that taxes are on sale. Taxes have never been as low as they will ever be ever again. So we want to take advantage of that. So one way, going back to being tax efficient, that we can do is we can do what's called a Roth conversion. So what that is, I talked about having all of this qualified money, which you have to pay taxes on. But one way you can be tax efficient in your strategy is, let's say you and your spouse you file married filing jointly. Well, the current 2023 tax bracket for married filing jointly for the 12% tax bracket is 89,000. I don't know the exact number, but it's around 89,000. Since you're filing as married filing jointly, you also have a standard deduction. Depending on if you're over 65 or not will depend on what your standard deduction is. But for the average American under 65, it's around 27,000. So what does all that mean? That means you could take your taxable income of 89,000 plus the standard deduction of 27,000, and that is the gross number of income that you can bring in and stay in the 12% tax bracket. And Tony, you're probably thinking, well, what does all that mean? Well, here's what it means. So let's say you need $80,000 to live. Okay. You want to enjoy your time. You want to bring home $80,000. Great. No problem. But guess what? There's a gap there between that $80,000 number and that 89,000 plus the $27,000 number. So what we can do there in order to be tax efficient is we can say, hey, this is how much room you have left in your current tax bracket. You're going to pay taxes on this amount of money for your income. But what we can do is we can fill up this tax bracket. Now, I don't like to get too close to the bear, so I won't go too deep into this, but we fill it up and we do a Roth conversion. You take out money from your 401k or from your qualified IRA. You go ahead and you pay the taxes on it at the 12%, and you move it to the Roth account. And it has to sit there for 5 years, but then after that, it's completely tax-free. So that's one of the ways we do tax-efficient distributions.
And what are some other? Now let's move on, but let's talk about taxes a little bit more. I know that Anthony has mentioned this in the past, but because of your experience with this, I wanted to ask you about tax-efficient assets to pass on to our heirs. I saw a tax nightmare when my grandfather died. He had a farm and left it to my dad and his siblings, and it seemed to be a tax nightmare. And so I know we're digging a little bit into estate planning here, but there are things that you could let our listeners know that they need to be looking out for, right?
Absolutely, Tony. So there are a number of things that some are beneficial to pass on and some are more detrimental to pass on. So I'm going to go back to those three accounts I talked about at first: the qualified or the 401k, the non-qualified, also called a brokerage account, and the third one, which is the Roth IRA. Now, the Roth IRA, investment-wise, is always the best thing to pass on because it's tax-free to you and it's tax-free to your beneficiaries. So that's number one, the best thing to pass on. But you might be saying, well, Michael, I don't have that. Like, I didn't do that while I was working, and now that I'm retired, what am I going to do with that? That's okay. That's where that Roth conversion strategy comes in. That's something that we can build for you. The next best thing is the non-qualified account or the brokerage account. So I mentioned on that one, while you're putting in money, it's tax-free because you've already paid taxes on it, but it's taxable for the earnings and the interest on there, interest, dividends, and any other type of growth on there. But when you pass away, your beneficiaries will get that non-qualified account at what's called a step-up basis. So what that means is whatever the current market value is at the date of death, your beneficiaries are going to receive that at that rate. So that is their new cost basis. So what's cost basis? All right. That $10,000 example I gave, you gave $10,000 to invest. That $10,000 was your cost basis. That was the amount of money you started with. When a beneficiary inherits a non-qualified account, they receive the market value is their new cost basis. It's the same thing with a house. So if you leave a house to your kids or your spouse, they receive that house not at what you paid for it, but at whatever the current market value rate is. It will get appraised, and then they can decide whether they want to keep it or they can sell it. And if they sell it, they get the tax benefit from it by like not having to pay taxes on it. Another asset that's really good to pass on is life insurance. Life insurance is something that is tax-free. You're paying it with after-tax money. You're paying premiums on that, whether you have a term life insurance that only covers from this point to this point, or you have a whole life insurance, which you're paying a little higher premiums, but it covers you for the rest of your life. If you're passing on a life insurance, that's completely tax-free money. So those are a few of the tax-efficient assets to pass on. Would be the Roth account first, followed by life insurance, because those are both tax-free. Then the non-qualified accounts, because they get the step-up basis. Now, you might be asking, well, what about the qualified account? Here's one of the catches on the qualified account. So one of the things with the qualified account, this was a tax law that changed in 2020, and you no longer can do what's called a stretch IRA anymore. So it used to be, prior to 2020, if a non-spouse beneficiary, so like your kids, or in your case, Tony, from your grandparents, if a non-spouse beneficiary receives a qualified asset, so again, pre-tax money, then before 2020, they could take that over a 25-year period, so over their lifetime. So it wasn't too much of a tax burden. However, after 2020, the tax law now states that that qualified account has to be completely depleted over a 10-year period. So they have to take required minimum distributions every year, but then they have to deplete that whole account over a 10-year period. Now, if you're passing on $200,000 or less, that's not a huge tax burden on them because it will be added to their income. But if we're talking $500,000 or more, actually any amount more than $200,000, that could potentially be a major tax burden on your beneficiaries, because you're leaving them with all this money that they now have to pay taxes on, which gets added to their taxable income. And if they're already doing well for themselves, now they have to pay this inheritance at a higher tax bracket because it wasn't dealt with appropriately now when we had the opportunity to do that.
Well, and that's really important then. Wow. So there are a lot of strategies out there. And I think that leads me to my last question for today's show that I wanted to talk about with you. And that is, this is from the list as well. How often should we be reviewing our plans, like our overall retirement plan, with an advisor? I mean, obviously, the first step is to have a financial advisor like yourself, somebody who's going to look out for your best interests, someone you can trust with this. But how often do you need to review these things?
Sure. And that's a great question, Tony. So leading up to actually having a plan, there's going to be a number of meetings. So in our office, we do 3 to 4 meetings. First one to kind of get to know you, understand what's going on. We interview you, you're interviewing us. And then the next one is to see, we're going to create a plan for you and whether you decide to do it. So there's going to be a number of meetings that you'll have before you even have the set retirement plan. And then it really just depends on your type of life cycle. If you're still working, we really don't have to meet with each other that frequently. 1 or 2 times a year is more than sufficient. The market's still working. We're still investing your stuff. You're still building towards retirement. But once you actually retire, that's when it's going to depend on how many times you meet with your advisor. So as you're transitioning to retirement, we're going to have a number of meetings leading up to that because we want to make sure everything's ready to go. All the planning documents are ready. All the paperwork is signed for you to start your withdrawal process because you're no longer putting in money. Now you're going to start taking out money. So there's a number of different meetings that will happen. So leading up to retirement, it just depends on creating the plan, anywhere from 2 to 4 meetings. Right before retirement, about 2 meetings. After you're retired, that first year, probably about 2 meetings in the year, just to make sure, hey, is everything going all right? Is this enough income? Do we have everything? How does it feel? Is it comfortable? Are you enjoying your retirement, etc.? Once you're getting past that initial retirement phase in that first year of retirement, you really only need to see your advisor once, maybe twice a year. But there's really no need to see the advisor more than twice a year. We can do phone calls, but there's really no need to have constant communication with your advisor once you're in retirement because everything is already running smoothly.
Sure.
So unless you need a change of income, then there's really no need to meet with your advisor more than twice a year.
Excellent. Well, great show today. A lot of information. Let us know, let our listeners know one more time before we go how they can get a hold of you.
Sure. Thank you, Tony. I do appreciate your time and everything. So the best ways to get in touch with us is either via phone call at 504-828-2171 to schedule your free strategy assessment, or go on our website at crescentcityretirement.com. Those are the two best ways that you can get in touch with us.
All right, and that does it for today's episode of Retirement Keys with our host, Michael Fite. Thank you for listening to Retirement Keys. Don't pay too much for taxes or retire without a sound income plan. For more information, please contact Anthony Kangemi at Crescent City Retirement Group. Call 504-828-2171 or visit the website at crescentcityretirement.com.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.